Humans have a biological and economic impulse to protect their own resources. When a state demands a percentage of a transaction, the natural response is to hide the exchange. Evasion is the predictable behavioral outcome of a system asking people to surrender their wealth. Traditional enforcement attempts to combat this through brute force. Governments deploy inspectors and threaten financial penalties, calculating that the fear of punishment will drive compliance. This approach introduces a severe systemic vulnerability. By sending a human inspector to enforce a financial rule against another human, the state constructs a lucrative secondary market for bribery. When an inspector catches an evader, a quiet negotiation begins. If the official fine is steep, the evader is motivated to offer a bribe. As long as that bribe is lower than the penalty and higher than the inspector's daily wage, both parties find it profitable to make a deal. The inspector walks away richer. The evader saves money, and the state, the entity relying on that revenue to fund its infrastructure and hospitals, retains absolutely nothing. Traditional tax enforcement relies on the fragile morality of underpaid individuals. To stop evasion, a system must instead be built on unbreakable mathematical incentives. If a government stops policing human morality and instead patches the underlying mathematics of its economy, the incentives for corruption disappear. This logic defines a theoretical economic model proposed for the Republic of Serbia, a radical redesign of how a state collects revenue and enforces its laws. This model operates on cybernetic negative feedback loops. In civic economics, these are self-regulating mechanisms where any attempt to exploit the system triggers a disproportionate counterforce, driving the system back to stability. We will examine two specific algorithms from this model: the exponential penalty system for tax evasion and the strictly earmarked excise tax for industrial damage. These algorithms function to make tax evasion and industrial pollution mathematically irrational acts. The foundation of this model is the exponential trap. Penalties for hiding money scale through algorithmic escalation rather than fixed percentage fees. A first-time evasion offense triggers a fine exactly 10 times the amount attempted to be hidden. The multiplier compounds with repetition. A second offense reaches 100 times the original amount. A third reaches 1,000. At this scale, a minor accounting trick liquidates an entire business. The 10x penalty mass is then distributed to finance the enforcement mechanism itself. 6 parts of that 10 times multiplier, or 60% of the total fine, are deposited directly into the central state vault. This covers the original missing tax and generates a massive surplus. 2 parts are legally guaranteed to the whistleblower or inspector who reported the evasion. The final 2 parts are allocated specifically to the prosecutors and officials processing the case. This bounty mechanism turns every private citizen and state official into a financially backed auditor. The state no longer needs a massive budget to hunt down tax cheats because it offers them a legal cut of the spoils. What stops a desperate evader from simply offering the inspector an even larger bribe to keep the penalty off the books? Imagine a business owner successfully hides exactly $1,000 in unpaid taxes. If caught, their baseline penalty under the 10x rule is $10,000. The inspector who catches them knows that by reporting the crime, the state will legally pay them a 20% cut of that penalty, exactly $2,000. The evader only made $1,000 in illicit profit, but they face a $10,000 exposure. They literally cannot afford to pay the inspector the $2,000 required to outbid the state's legal bounty. Any bounty system risks exploitation through false reports intended to trigger a payout. The algorithm accounts for this by applying the exact 10 times penalty to anyone found intentionally fabricating a report. For a powerful evader who attempts to bypass the inspector by bribing a high-level judge, the system applies a different multiplier. A state official caught taking a bribe faced the total seizure of all personal assets, the seizure of all connected persons' assets, and a lifetime ban from public service. By structuring the math so the state always outbids the criminal, using the criminal's own future penalty, the risk-to-reward ratio for corruption disappears. This principle of algorithmic enforcement can be applied to the long-term damage caused by massive corporate entities, what economists call externalities. Traditional responses to industrial pollution or unhealthy products involve an excise tax, often called a sin tax. This chart shows the 2019 Serbian budget. Excise taxes, in green, account for 23.4% of revenue. Governments rely heavily on this. However, it's delved into a general budget for roads, rarely spent to clean the rivers or heal health conditions those products caused. This creates a perverse incentive. By relying on sin taxes to fund normal state operations, the government becomes a financial partner of the very industries destroying its citizens. The 141% rule fixes this incentive by transforming excise taxes into strictly earmarked algorithms. The state determines the exact economic cost of an industry's damage, then levies a tax equal to exactly 141% of that cost. 100% is legally locked to direct cleanup. The remaining 41% funds future prevention. Manufacturers must raise the price of their harmful goods to cover this unavoidable tax burden. This forces the consumer who chooses to buy the harmful product to pay the true cost of its destruction up front, rather than pushing that cost onto the general taxpayer. Success for the 10x penalty and the 141% tax looks like a revenue stream of absolute zero. When evasion and pollution become too expensive to exist, the algorithm has achieved its intended state.